Hello and welcome to Investors Hangout. This fortnightly interaction to help you learn and understand savings and investments better is brought to you by Aditya Birla Sun Life Mutual Fund and Value Research. With me today is Dhirendra Kumar, CEO Value Research. Welcome, Dhirendra.
Thank you.
Now that we're headed towards the end of this financial year, one common question that most of us, have in our mind is where should one save to save taxes? Where should one invest to save taxes for availing the popular ATC deduction benefits from there? So how would you suggest to exhaust that 1.5 lakh limit?
Ideally, it should be a planned affair. It shouldn't be done in March. The other is that, you are not left with too many alternatives. Your provident fund deduction and, insurance commitment of paying the insurance premium will consume most of it anyway. But nevertheless, if you are left with any opportunity to invest, to save tax, which will lead to, saving taxes, one must do it. Tax save is money earned, and the entitlement is pretty straightforward. 1.5 lakh rupees investment in stipulated investments or directed investments or some kind of expenses. And broadly, ATC entitlement, if you classify it into three parts, three kinds. One is equity investment, which is only the tax saving mutual fund. The second one is all kind of hybrid and fixed income, which is ULIPs, and the fixed income instrument like PPF and other things. And the third part is the expenses, like what you pay for the insurance premium, what you pay as tuition fee for your children. So that to an extent that will also be your entitlement. So if you have not invested in any of the investment, I think one should look at it very closely. Exhaust, even if you have to borrow to invest, you should do it, simply because it's worthwhile. And that is, if you look at all the options, ATC, the ELSS, the tax saving mutual fund, is the only one which is equity oriented. Everything else is either fixed income or insurance linked or some kind of expenses. And because any tax saving investment comes with a lock-in period, better to go with ELSS, because you are getting stuck anyway, might as well make more money.
Also, don't you think this 1.5 lakh limit, it's high time to enhance that limit, because in today's time, in day and age, what is 1.5 lakh after all?
Absolutely, this was done about 10 years back, and government itself comes out with tax inflation index, and if you just adjust it by the tax inflation index, it should be something like 3-4 lakh rupees, because the worth of 1.5 lakh rupees 10 years ago is not the same as today.
Right.
So I have been writing my columns every year with regularity that this is something which should be automated. It should be linked to the inflation, and for once, it should be adjusted.
Isn't ELSS more volatile? Also, I heard that the category has been witnessing outflows over the past few months. So, what should be done about that?
Equity is always volatile, and volatile is being used in a very unusual way. When markets go down, people say it's volatile. When they go up, they don't say that it's volatile. Volatility is something which oscillates in a range. My sense is that because it is volatile, it gets you more return if you hold it for a longer period, and because you will be getting stuck with any other tax saving fund, tax saving option, whether it be PPF, and all other options come with a longer lock-in period, 5 years, definitely 5 years. So I would say that this is something which comes to you with the least lock-in period, and because you are getting stuck, might as well make more money. So go for ELSS. The other reason there is outflow or redemption from tax saving fund, it's not unusual for investors to take money out of mutual funds when the market has gone up after a big decline, and that is what we saw. 2020, we saw that the market dipped. Everybody was waiting for an opportunity, and it has gone up so dramatically. Every day you listen to the headline and it says that market crosses 50,000, then it crosses 51,000. So people look at their investment values, they find that okay, it has done well, take their money out, but they will come back again, and it doesn't matter. People in taking their money out or investing more money is not your problem. The real thing is that will it yield better return for you if you are investing for a 3-year time period? And I would say that look beyond 3 years. Think of it, if you're a person who can only save 1.5 lakh rupees in a year, you should do it religiously and do it for 20 years. This will be your retirement fund. This will get you everything, because if you compare it, this is the charm of making an investment and holding it for 15-20 years. And if it is yielding 12-13% instead of 8% or 7% in PPF, you will find the magic of compounding visible clearly over such longer period. People invest for long term, or they have long term goals, but they look at it every day and they want their investments to be performing every day. Your equity investment is not a laborer. It might look a very risky thing, volatile thing, bad thing, or if you look at March 2020, it might be quite unnerving. But we know that if you hold it for a period, if you are able to, the reward for withstanding this volatility is magic.
What about investing in NPS to save taxes?
You have a new provision for NPS, which is 80cc. So the maximum that you can invest in a tax saving fund or a tax saving alternative is 80C. Now there is an additional 50,000 rupees which is possible to invest, and so which means that you can invest up to 2 lakh rupees, not 1.5 lakh rupees, but 50,000 is exclusive for NPS for ordinary investor. So if you do that, you get that benefit. That apart, earlier NPS was, you have to be a little careful about it. If you are many years away from requiring that money or many years away from retirement, then have 75% into equity. Because earlier it was not possible in NPS to have larger, sizable equity allocation, and that was a big problem. Even now, you have to, of course, NPS comes with a longer lock-in. It will be linked to your retirement age, so you have to hold your investment till that time period. But it is still a worthwhile thing. Investing for and I look at it very positively, that investors often take their money out in NPS because you are stuck. You will never take it out. So I look at it differently. Of course, if you're discipline yourself, then it's okay. You don't need that kind of reinforcement or locking you into NPS. But this is one should avail that if you have that scale of savings.
All right, time now to move on to the viewers' questions. The first one comes in from Subhash, who's only a couple of years away from retirement. And so he asks, should he still invest in ELSS to save taxes under 80C? Would it not be better to opt for fixed income based alternatives?
Yes, maybe. But are you likely to, anybody investing and about to retire, he will have all kind of alternatives. It entirely depends on his context, his situation. If he is going to retire and he will get his pension, then he should invest in ELSS. If he's going to retire and then all his savings, everything will be needed to generate income for him, then he should not invest in ELSS. Because with 2-3 years time frame, you should not be investing if you intend to derive income from that. And somebody approaching retirement and all his investments to be cobbled together, to be consolidated at one place, and then you are going to work on a 6% withdrawal plan or a 4% withdrawal plan or a 7% withdrawal plan, and that will actually support your essential income requirement, then you should not.
All right, the next question has been sent in by Malhotra. The full name is not mentioned here. He says he couldn't provide the required investment proofs when the accounts department of his office asked in January. Can he still claim the deductions in ITR even if they have deducted the TDS?
Absolutely. Your income tax return, because you could not give the evidence that you have invested, so all accountants in any organization will err on the side of caution, because if they don't have the evidence, they will be liable for non-compliance if they don't deduct the TDS. But because you have the deadline for making that investment is 31st March, if you do that, you will be eligible. And in your income tax return, you will be able to file that, okay, you made the investment and there has been a higher tax reduction. I'm experiencing, not only I'm told, that tax returns are very seamless. One fine day you realize that without much of a noise, they hit your bank account.
Now Rajesh wants to know, how are the returns of ELSS taxed?
They are taxed as equity returns. So you have to hold it for 3 years, which is mandatory, and then 10% long-term capital gains tax, because there can't be a short-term capital gains in ELSS. So 10% of the gains is gone by way of taxes as long-term gains.
Also, is there a TDS on your redemption?
No. You get all the money and you are supposed to pay 10% long-term capital gains tax on, and which naturally will be, because there is a 3-year lock-in period. But there is an advantage that if you have some capital losses and there is a capital gain on equity, they can offset each other.
Okay, all right. Now, Gaurav Ghosh asks, is there any difference between an ELSS fund and a multi-cap fund apart from the tax treatment?
Mostly not. They are multi-cap and this, yes, so are the ELSS. But there could be some characters, the ELSS fund, they normally have slightly higher allocation to mid-cap, small-cap or relatively less liquid securities, simply because investors invest in ELSS and the fund manager knows that this much money is not going out of the fund for next 3 years, and he has a very precise understanding of what is the life of the fund with them. So in that case, the fund manager can actually take a bet or take a view or invest in relatively less liquid or allocate marginally higher to less liquid instruments, equity instruments, which can yield higher return.
Okay, now the next question has been sent in by Kshitij, and he asks, which plan among growth and dividend should he choose while investing in ELSS?
I would say that when investing in equity, always choose the growth plan, because when you are investing in equity, your objective is capital appreciation, and after 3 years anyway your money will be free from lock-in. So any equity investment, I think the basic principle should be growth. Even in fixed income funds, because now your withdrawal plan turns out to be more tax efficient, one should go for the growth plan. So dividend plan for all practical purposes you should ignore, and that does not really deprive you of any, it's not causing any disadvantage, because anytime you require the money, you can redeem a small part of the money which you at your will whenever you want to.
That's right. Now Ritika wants to know, across how many ELSS schemes should she spread her tax saving investment? She plans to invest about 1.2 lakh rupees in March.
Next year onward, I think she should start investing. Averaging your investment is crucial. But nevertheless, I think 1 or 2 funds will be good enough, and keep track of your investments. I find that tax saving investments in a span of 5, because it's a long term thing, 5, 7, 10, 15 years, you keep on holding it. So just keep track of it, and no more than 2 funds, I think.
Now, today's last question has been sent in by Dr. Shashi Bhushan, who wants to know, an appropriate investment plan for a retired and re-employed central government employee beyond 65 years of age.
Congratulations, he's still earning beyond 65, but he'll be getting pension, and he will have the CGHS available. A central government employee, he has the health insurance of a very liberal kind available to him. So because you'll be getting because all central government employees get inflation adjusted pension, so his retirement plan is actually done. So keep investing all your money in equity as much as possible, and unless you require any supplementary income.
That's it for today. Thank you, Dhirendra.
Thank you.
Thank you to all our viewers. Do keep sending us your questions and keep watching this space for more information. Bye for now.